Hey everybody, Courtney Smith here with our weekly video newsletter, TradeSmith. Let's get right to our famous disclaimer here. Very important that we disclaim, and then disclaim again. I know you've got this memorized, but please read it again because it's so fantastic and so entertaining. All right, let's get right to it. So here's the story. I look for the market to rally this week. Couple things. Number one, you can see that the price got down to a previous low, not a major low, but at least a previous low, and bounced. That's that horizontal green line. And we left what's called a reversal bar. And a reversal bar is where we make a lower low, but then we close higher than yesterday. And that at least is a short-term bullish signal. So the combination of the two makes me think we're going to rally. But here's another thing. Notice how that the price did not break that low. So you take the green line and you go over to the left to the end of the green line and there's a low there. And we didn't break that low. But now look at the green line with the red arrow pointing towards it, the thin line, that's the RSI, the relative strength index. And that did make a lower low. So normally when we see that kind of a divergence, we expect the price to rally. And because of the reversal bar, I think it's going to rally right now. In addition, the last week, we saw declining volume. Look down at the bottom of the chart and you'll see that declining volume. So all of that tells me that we should see a rally this week. Not to break the old highs. Just a little rally, no big deal, 20, 30, maybe 40 points on the S&P, but let's just call it 20 points on the S&P, something like that. The one thing that bothers me is that reversal bar occurred on lower volume than the day before, which means that it's not a very powerful reversal bar. So just look for a little bit of a rally here, particularly early in the week. And then we'll see how it goes after that. But my overall opinion is still the same. We're in a corrective phase. We're not going to go be making any new highs anytime soon. We're just correcting from the big bull move we had since February. Same thing here in the Dow, reversal bar, the declining volume. No real difference here than with the S&P. Here's the NASDAQ. The NASDAQ, you can see, is much weaker. We actually did break those old lows. So we need to stay away from the technology and sexy stocks of the NASDAQ, and we need to focus on old-fashioned boring stocks, industrial stocks, consumer staples, utilities. We need to go back into that phase right now because that's where the market is rewarding us. It's not rewarding us to be in the sexy high flyers right now. Seasonality remains bullish, and it was going straight downhill there for a while. 108 on the IWM, that's the Russell 2000. If we break below that level, then I'm going to stop being aggressive in the market on the long side, and instead I'm going to have to be more defensive. We haven't looked at this for a while, but as you can see, at the beginning of May, the market should be selling off. This is from Stock Trader's Almanac, highly recommended. If we look at the top bar, which is the blue one, that's the one I think that's in most effect here. But nonetheless, you'll see that from the beginning of May to the end of May is kind of a down month. And, well, we're in that month. Then in normal election years, we embark on a very sluggish bull market. No big deal. This is not an explosive bull market. Now, then there's the black line, which is the trifecta. And the down trifecta is basically we had a first 5 days of January down. The Santa Claus rally wasn't a rally. It was a nothing. And the month of January was down. And when those three things happen, you can see it's actually a bearish year. We should expect to see the year down around 5 or 6%. Nonetheless, from May until end of June is bearish under this scenario. Now, of course, we don't know which one of these is the true scenario, but so far it's followed the down trifecta more closely. So once again, maybe it's even a down year for the year. Probably not, but it's either up 6% or down 6%. So let's call it about even. So what we want to do, however, The good news is that it's not a stock market, it's a market of stocks. And there are some sectors like consumer staples and utilities that are going up. So we can make money in this environment. We can make good money in this environment. All right, the yield curve is a background bullish feature. The arrow shows where the yield curve was a year ago. And remember that this indicator predicts the market a year in advance. So looks pretty good. So that's going to be a background bullish factor. Now, asset allocation continues to weaken. It continues to show that money is going out of the stock market and into the bond market. Risk appetite also, look at that, broke to new lows. Well, I'm famous for doing technical analysis on fundamental analysis, and that's what we're seeing here is the beginning of maybe a bear market and people getting away from risky assets and going into non-risky assets. I'm starting to repeat myself, but consumer staples and utilities are the place to be. Not the big FANG stocks and the ones that are glamorous. No, we need to be in boring stocks because they're going up in price. And remember, our job is not to look sexy, it's to make money. Global shares, not as strong. This is just terrible. I don't think we really want to be in overseas stocks, with just an exception. We'll get to that. The Spanish shares showing weakness, so I'm going to take them off the sheet. They're just not in a bull market anymore. UK shares also, they were holding up so nicely, but they cracked. The only market that's going up is the one I keep telling you about, which are Greek shares. So in spite of labor strife this week, in spite of a huge, an important election coming up, a vote in Parliament coming up, this market's up over 50% from its lows. You got to be long Greece. Greece is where the action's going to be this year on the long side. Bond market, you can see rallied as we projected, and we're getting up towards the high end of the range. So on a purely technical basis, we shouldn't expect the market to go much more than up to about the 132 level, maybe 132.5. But really, we're very, very close to the high end of this rally. We could even be capping out in the next half a point. So bonds had the rally we expected. Now I don't expect that rally to live much longer from a purely technical point of view. Now from a fundamental point of view, it's still a mess. The gold, which is the top line on the right-hand side, cleverly labeled in gold color, that's suggesting higher interest rates. Now remember, higher interest rates means lower prices. So it's saying higher yields, lower prices. The other two indicators are the CRB index of sensitive commodity prices and the 10-year Treasury yield in Germany. And they're both, I'm calling them sideways. So net, once again, let's go back to this chart. I'm looking for higher yields a little bit, not a lot, just a little bit. And that means that this chart, these prices are going to start to go down again. So look for that in the coming week. The dollar, we got up to that resistance zone, which I've drawn in a squiggly red line there. And of course, you can see the downtrend line is coming in. So I really think this rally in the dollar is over. Now, what does that mean? Well, if the rally in the dollar is over, that's going to give a boost to the price of gold. It's going to give a boost to the price of oil and all other commodity prices. So we need to keep a very, very close eye on this. If it breaks that downtrend line, that green line, then all bets are off, and I'm going to take the exact opposite opinion. So keep an eye on that. Here's gold. Look, it was down last week, but just a normal correction. The action on Friday was very bullish to me. I think this has taken another leg. We're going to new multi-year highs in the coming week. So gold is a place I want to be. In particular, I want to be in gold shares. GDX, GDXJ are two ETFs. One is big cap miners. The other is small cap miners. And our indicators, well, they kind of hook down, but in the context of being up. So I'm going to still count them as all bullish, but weak bull. So we're not looking for an explosive bull market in gold. We're looking for a weak bull market in gold. Oil, bull market. I was getting pretty bearish, I have to say. I'm turning a little bit more bullish. I think really what's going to happen is a whole lot of nothing, but there are bullish factors in the background. But I keep looking at the price and saying it's getting too high, that these high prices should induce more production. But in actual fact, they're not. Production continues to decline. And so I'm starting to get a little bit more bullish. I thought we'd get into this mid 40 area, but maybe we can get into the high 40 area. Technically, that's what it looks like, but I'm talking about from a fundamental perspective. It looks like we might have a little bit more on the upside. Maybe, I don't know if we'll get to 50, but we should get up close to 50. All right, everybody, thank you very much. All you freebies, love you, but of course, we'd love you more if you were to sign up for our paid-for thing. Just go to that website up at the top, sign up. It's less than a Starbucks coffee every day. Not to denigrate the Starbucks people. I like their coffee. But hey, I like TradeSmith even better than coffee. What can I say? All right, everybody, we will talk to you next week. Thanks very much. And hey, all you fully paid up members, hang on. We'll be back with you in just a second.